Let's welcome on board Dipan Mehta as well as Kunal Bothra too joining in right now. Dipan, hi, morning. Good to have you on the show. Can't help but talk about the new GST rejig which was announced last evening and gaming. I mean, is it really literally game over now for the likes of a Nazara and Delta with that 28% tax which has been slapped with no distinction between game of skill and chance?
Good morning and thank you for having me on your show. I don't think Nazara is impacted as much. I think management has come and said that their revenues are about 5% from gaming and EBITDA contribution is 10%. So from that point of view, Nazara has been conservative and they have avoided getting full on into this real money or any other form of gaming products per se. And another, I think, strength of Nazara is they are not focused or not concentrated in any single product or any single in the gaming industry. And even geographically also they are quite well dispersed. So from that point of view, I don't think it's going to get impacted. Of course, it will be sentimentally negative for Nazara. And to an extent, I think the kind of opportunities which they could have pursued, that certainly kind of narrows down for them. But from an absolute result or performance perspective, I don't think the impact will be much. But yes, sentimentally, certainly going to affect the Nazara stock price. Delta, I think, is another cup of tea altogether, and this may hit them really hard, waiting for the management's comment on how they react to this particular development, because it speaks about 28% on the chips which are purchased. But, there can be ways of, working around that thing as well. Considering that, the chips return, what about those? How is that to be considered in the tax perspective? So waiting for a kind of a response from them, and then we can evaluate. But sentimentally, it's negative for both stocks, and you may see a slam dunk, a downward tick for these companies.
Dipan, the question is, will you buy that slam dunk? Would you use that opportunity to buy the likes of Delta and Nazara? Because as you pointed for Nazara, it might be a lot more sentimental rather than actual because it is just 5%. And Delta also a good buying opportunity, perhaps?
No, not really. I think, I've seen in past situations like this when there's so much of adverse news flow and so much of uncertainty as to how the consumer will react to these kind of a tax structure, it's better to just stay away for 2-3 quarters, let the dust settle down, let us see what the real numbers are and how the impact has been, and then take a call. It's not that both these companies had on a phenomenal growth path and generating 50-60% type of growth rates, and were in the center of the entire gaming revolution which was taking place. So from that point of view, we just want to wait and watch. Nazara in any case is very, very expensive considering its traditional like price to earnings or price to book ratio. And again, they want to go ahead and raise capital and dilute equity as well. So that's another aspect to consider. So I would avoid both these companies, although as a disclosure, we have investments in both Nazara and Delta. And I think I'll have to take a bit of a knock on that holding over there early in the morning today.
Thanks so much for making that disclosure. So, yes, guys, even Dipan has been invested into both Nazara as well as Delta. But what he's suggesting is don't try to get the FOMO and buy on lower levels. Just take a conscious call as to what you want to do, whether you're holding it for the short term, whether you want to wait for the long term, and then take a decision. In fact, just wanted to highlight that apart from Nazara and Delta, you also have On Mobile, which will be in focus, as well as Zensa Tech. Both of these companies also have exposure towards the online gaming business, so watch out for these two as well. Dipan, that was about a couple of those gaming names, but what about the IT sector? I'm guessing you hold TCS as well. If not HCL, what would be the expectations there?
Yeah, I think I own a lot of IT stocks, and I'm prepared to ride out this soft spot or the soft quarter which they are in. I remain fully committed that the long-term prospects of the IT industry are fantastic. They are certainly improved with the advent of AI and ChatGPT, and all the more of those kind of projects may come to these companies. So it seems to be like a new tech wave for the entire software industry. And it's just a matter of time that tech spends start to improve once the kind of macroeconomic headwinds recede. So very positive on the longer term prospects, and the time to sell is frankly gone as far as a lot of the tech stocks are concerned. They have corrected significantly from their highs as well, the large cap ones at least. So you just have to wait out this soft period. I've seen many such points of time in the history of the software industry where they go through such phases where the growth is flat slightly declining, and then it just comes roaring back as well. But I think my concern is more on the mid-cap IT stocks, the likes of, say, Tata Elixir or Persistent Systems, KPIT, Coforge. I think they are trading at very rich multiples, and any kind of miss on the earnings over there could have a very extended adverse impact on their stock prices. And we are invested as a matter of disclosure in all of these companies as well. So I'm just bracing myself for a tough quarter when it comes to software, and I will maybe react in terms of an opinion on these stock prices once the actual numbers are out.
Yes, indeed. That entire space as well will be closely watched out for. And recently as well, we did have some downgrades as well coming in from JP Morgan on the entire mid-cap IT sector, in particular L&T Tech, Persistent, KPIT Tech, as well as Tata Elixir. And they were talking about, as of now, how the ER&D spends have been slowing down the last 6 months, and that is structural in nature and not cyclical. But that aside, Dipan, wanted to get in your take on the entire cement space, given the fact that now analysts believe that demand continues to remain strong, that lower costs as well are coming in as a positive. Do you think that perhaps the only major concern for this sector would be valuations, which continue to remain very high?
See, my view on cement has been negative for a very long time, but I certainly feel that there could be a trading rally in cement when numbers are announced for the June quarter. It could be a strong quarter. Volumes have been holding up pretty well, and definitely benefits of lower cost will accrue to the industry. My issue is that the longer term prospects seem a bit blurred considering the kind of capacity expansion which is taking place. So there is real risk of a glut, and that could lead to depressed prices. That is one. And secondly, I think that overall, over a longer period of time, we see multiples compress as far as the cement industry is concerned, as ROIs also drift lower, and the kind of price discipline which was there for the past several years, that may get vitiated with the entry of new players in the sector as a whole. And I see better opportunities within the cement consumers. I mean, look at the way the real estate companies have been reporting pre-sales and new projects, and the way engineering and construction companies have been reporting excellent numbers and bulging order book position at decent margins. So from that perspective, I feel more comfortable in the cement consumers than the cement producers.
Talking about the real estate pack, today as well, there was a fresh HSBC note. They've actually raised their recommendations on both Prestige Estates as well as Sobha. Both are now at buy now. The price target for Prestige is 720, for Sobha it's 730. And Prestige, of course, also had that news flow regarding the land that they have bought from DB Realty in Mumbai itself. And that's expected to be another prime property that they would be launching. But within real estate itself, where does the preference lie?
Oh yeah, lots of choices in real estate, and you could really pick and choose. All of them are having a great moment at this point of time. The entire sector has livened up phenomenally, and depending upon your risk appetite, you could look at, if you are highly risk averse, then Godrej Properties, DLF, Macrotech, offer some comfort considering the size, the balance sheet quality, and the diversity of their projects. But there's a lot of value in companies like Shobha as well as Prestige, and this particularly new project of theirs could be quite a big contributor to the revenues, considering that real estate prices in Bombay, especially that the premium level, are at record highs, sky high levels, I would say. So from that point of view, it opens up an opportunity for Prestige and provides them a foothold in the I would say the richest real estate market in India, that being Mumbai. So very positive on all real estate companies, but 3 or 4 which we track, which I feel more comfortable about, but I'm sure there are many others as well which should report very good numbers going ahead.
Okay, so by and large bullish on the entire real estate space. Let's welcome in Kunal Bothra as well, who's joining in on the charts. Hi Kunal. First up, let's get your top picks going.
Good morning, Avan. So I'll go with a couple of buy calls over here. And the first one is actually a buy on Sun TV, expecting the stock to get into a very strong breakout mode. So for the first time, I think you're seeing some positive signs emerging on the charts for Sun TV. The stock breaking out of its major resistance around the 450 to 455 mark. So would suggest a buy with 494 as a target for Sun TV. Stop us at 464. And the second would be a buy on KEI Industries. Again, a classical chart, has been a consistent performer over the last so many years. Even on the short-term basis, the stock is coming out of a minor consolidation. So we would expect a breakout for KEI Industries and an end of a minor consolidation, 2450 as a target, and stop us at 2200.
Okay, there you have it. Those are some of the top calls that Kunal is recommending. But Kunal, let's also get in a take on some individual names on the charts then. You've got the entire crude basket that will be in the spotlight, largely on the back of the fact that crude is nearing close to $80 per barrel. How are you looking at the charts of an MRPL or a Chennai Petro basis the kind of move that they've seen?
So, most of these stocks like MRPL, for example, in the last 2-3 months, when we look at it from the March end lows, these stocks have done exceptionally well. From 60-65 rupees, MRPL has gone into a strong rally mode. I think 90 or 91 was the high for MRPL. The stock had made last week or so. So it's been a phenomenal rally for these stocks on the back of what happened to the crude oil prices from the 2022 peak. I would believe that there could be some tapering off of gains for these stocks over the near term. But in terms of support patterns, I believe, for example, for MRP, 75 to 80 is a huge band of support for the stock price, where the volumes had jumped up higher. We look at the VWAP support for the stock prices, both in terms of volumes as well as the weighted average in terms of prices. So that also lies closer to 75, 77 mark for MRPL. That's again a very good territory. In case the stock happens to correct and come back to those levels, that could be a very good classical re-entry point or the mean reversion point for MRPL for traders who are looking to buy. Chennai Petro, on the other hand, I think closer to 400, 420 is a strong support zone for the stock price. It's a more of a steady stock as compared to a stock like MRPL. Chennai Petro has been a stock which moved from 300 odd levels to now 440 odd plus mark for itself. Again, classical volumes, very steady kind of chart for Chennai Petro. 420 could be a good entry point in case the stock dips to those levels.
Okay, I just wanted to get in a take as well on Reliance Industries from you then, Dipan. Given the fact that after the announcement of the Jio Financial demerger, we've seen the stock close to an all-time high. What's your outlook on Reliance Industries?
So I think it's playing catch up for one because it had been underperforming for the past several weeks or so. And this demerger has put the focus back on Reliance. And I think a lot of value has got established as far as Jio Finance is concerned, as we have become aware more and more of the financials and the balance sheet status of that company. But the clear question in mind is what is going to happen with the other larger businesses, that is Jio Platforms and Reliance Retail. Are they going to go the Jio Finance way, where shareholders will get free shares, or are they going to go for IPO and Reliance becomes the holding company? I think time is ripe to answer that questions on the part of the management, and maybe they are thinking also on those lines. Given that three very distinct and disparate businesses are there in a single company, and that is not completely attractive to investors, because investors may want specific exposure to the tech business or the platform business, but some may prefer to buy the retail business, and the value investors may want to look at the refining and the plastic business. So having it all combined in a single entity makes it less attractive to investors, but having separate listings certainly will attract a lot more players into it. But how that separate listing going to take place is the big question mark. And going by Jio Finance's kind of a demerger, I am hopeful that we could have demerger of the other two divisions as well, which will be a huge value unlocking opportunity for the minority shareholders.
Reliance has become more of a value unlocking and a special situation kind of stock rather than just the fundamentals. But Dipan, what's your view regarding PVR Inox? The stock has been quite beaten down. Of course, there was a bit of a relief coming in with respect to the GST rate for F&B being decided at 5%. But then there are a slew of lined up. Today, of course, there'll be Mission Impossible that will come out. There's Oppenheimer, there's Barbie, there are a lot of Hindi movies as well. Just the release of the promo of the SRK star Ghulam also came, and all of them look quite meaty. Would you think finally that PVR would be out of the woods and something that you should look at around 1400 levels?
First, the disclosure, we are shareholders of PVR, and I think every upside we're looking at exit opportunities. And the reason for that the habits have changed. And more entertainment is being consumed online. I would say through OTT platforms to an extent, even through gaming. So I'm not that positive on the prospects of Inox PVR. I mean, optically also, when we talk to people, young generation, our generation, fewer and fewer visits are there to the multiplexes. I don't know how that's going to change as well. So I'm very negative on PVR Inox. It's not that the stock is actively valued at lower EV to EBITDA or price to earnings multiple. It's not that they are extremely high return on investment or return on equity as well, which justify high P multiple. And on the whole, I think they will find it very difficult to sustain volumes going forward also. And I think enough of this volatility in earnings as well. If you want to play the consumption entertainment theme, there are many other opportunities, and that's where we should be looking at.
Okay, appreciate you being candid there. That's the view coming in on PVR Inox. Meantime, Naresh, let's get in a take on some of these buzzing charts yesterday. Bharat Dynamics as well as a Cochin Shipyard.
So we've seen the strong momentum continue in the whole sector. Bharat Dynamics, after consolidating, took a little bit of a dip from 1200 plus level to 1100 and has again made a fresh 52-week high and all-time high. It's just that after a move of 10-15%, the risk reward is not great. So this would be still be on an avoid. Cochin Shipyard, on the other hand, still looks more interesting. The previous high for the stock was 680 to 700. From there, it corrected all the way to 430. And now has started making a comeback. The last high was 600 and it has crossed yesterday and made a move to 650 level. So on a fade off today to 610 to 620 would be a good entry point. Eventually the stock could cross and break out into new all-time highs. So Cochin Shipyard, out of all the names, still has a risk reward, possibility to take a buy on dips. The other names like Mazgaon Dock, etc. have been a one-way rally. Cochin Shipyard has a lot to catch up relative to the rest of the space. So a fade off today should be an opportunity to get into Cochin Shipyard.
Okay, and Kunal, what's your take regarding Lupin? Yesterday, towards the end of the trading session, we saw a bit of a spike coming in, given that the positive news flow regarding the Pithampur facility came through. But on the charts for Lupin and any other pharma name, even Piramal Pharma, because that's also seen a bit of a positive note coming in from the pharma.
So I'll start off with Lupin, Nisha, because I think Lupin is a classical chart. I remember in 2022, on the time when the results were extremely negative for the stock price, closer to 600 or 620 is where the stock bottomed out. There was a classical reversal which had happened. We look out for price reversals for Lupin, and from there, the stock has just gone through a very steady uptrend. Look at this one, the stock has not yet picked up pace in terms of the kind of battering the stock had seen 5 years from, I think, 1200, 1250 odd mark to a point where the stock dropped by 50% to come back towards 600 levels. So it's now seeing a recovery for itself. I believe that there should be more legs on the upside for this recovery for Lupin. I wouldn't be surprised that possibly in the next 12 months to 18 months, we could be looking at the stock coming back closer to that 1000 plus, 1000 to 1200 kind of a target range for itself. So I'm extremely bullish on Lupin, and I believe that the recent recovery which the stock has shown over the last 6 to 9 months is something to probably expect from a long-term play. Other than Lupin, the other pharma stock which also looks attractive, in fact, yesterday we were discussing this extensively, was Sun Pharma, the stock confirming a breakout of multiple resistances around this 1050, 1060 odd mark. So almost like a triple top breakout for Sun Pharma, which is a very rare kind of a pattern, because typically triple top resistances, they act as more resistances or hurdles for the price charts. But this seems to be a breakout for Sun Pharma. So that's another stock which looks attractive. From the mid-cap pharma name, the couple of stocks which I've been very bullish on, Glenmark, pharma, I think at 650 to 660 plus mark where the stock is trading right now, again looks very attractive. The way the stock has moved in the last 6 to 7 months, breakouts on the charts on the weekly and the monthly basis, and even Zydus Life. On Piramal Pharma, on the other hand, because of the limited price history, I sense that the stock had fallen very sharply from 150, 60 levels to, I think, at point where the stock was at 50 or 60 rupees. So it's now getting into a recovery phase, Piramal Pharma. It's come back just on the 90 plus mark. So I believe that maybe some bit of more rally could be seen to the stock price. 100, 105 is what I would expect for Piramal Pharma, but because of the paucity of charts, difficult to focus on a longer term basis.
No, fair, I take that point. Let me toss it to Dipan. I think he'll be better placed to answer that. Dipan, your view on Mankind Pharma, Piramal Pharma, if you track either of the names?
See, Piramal Pharma, I think, is doing a lot of catch up in terms of valuation, but don't really prefer the kind of business model that it is in. There are a lot of opportunities in other stocks as when it comes to contract manufacturing. And we want to companies which are more consumer focused. From that point of view, Mankind Pharma, I think, certainly looks very, very interesting, with 97% of the revenues coming from the domestic market, and they have a very strong position in their brands. Their strategy also is now pretty well appreciated, having focused on tier 2, tier 3. I understand from the industry sources that their average brands are 10-15% cheaper than the popular ones, and the kind of manpower they have on the street is quite phenomenal. So it's just a compromise on the valuation. So we're just waiting for the right point of time when Mankind Pharma will have that perfect margin of safety and risk return profile in favor of the investor. So I would say that our top pick within the sector has to be Mankind Pharma, a disclosure that we and our clients may be invested. And we would like to look at and advise as well to move, increase the exposure to Mankind Pharma. But I'd like to see this quarter's numbers to have a more firm and more convinced view on the stock.
All right, Dipan, good to have you on board. We've really managed to get in a lot of stocks, and thanks so much for sharing with us your views. Okay.